All right, well, what's the benefit of getting this hedge accounting? I mean, that's really what we want to find out because we don't like the current accounting for derivatives, which is fair value, changes in fair value, go through the income statement. So let's set up a little bit of, we'll call this our hedge accounting. The way we're going to account for different things with hedge accounting before versus after. So we've got no hedge accounting. And we've got hedge accounting. We've got our cash flow hedge. We've got our fair value hedge. And we've got our net investment. Okay? And with each of these, we have the hedged risk and the hedging instrument, which is a derivative. Hedged risk, hedging instrument, hedged risk, hedging instrument. Okay? So we can now create an extended 3x2, if you will. And we want to make sure that we kind of separate out the accounting for the hedge risk versus the hedging instrument, which is a derivative. And in this particular case, it doesn't always have to be a derivative, but in this particular case, we're dealing with it's got to be a derivative, even in the net investment hedge. Okay? So, before hedge accounting, put this in black, the hedge risk for any of these things is going to be amortized cost or net realizable value, whatever the normal accounting is that you already learned about a particular transaction set. Same thing here, amortized cost. Or lower of cost or net realizable value, lower of cost or market, whatever the accounting is. And then with a net investment, the hedge risk here, this is going to be at fair value with changes in fair value going to OCI, right? We haven't learned this for the net investment of a entity, but we're going to learn this in the next couple of weeks about how do you deal with a foreign subsidiary denominated in a different currency, right? It's called translation gain or loss, and in this particular case, when we're dealing with a net investment of a consolidated subsidiary, that change goes through other comprehensive income. For all of these, we also understand what the accounting is for the derivative. The derivative is fair value with changes in fair value going to the income statement. Fair value, changes in fair value go to the income statement. Fair value, changes in fair value, go to the income statement. Okay, so this is the accounting. So here I've got the hedged risk at amortized cost. I'm trying to mitigate the risk, but I still end up having an earnings hit across all three of these, even though I'm doing the right thing. So I go through the four criteria to be able to qualify for hedge accounting. Identify what's the hedged risk or the hedged item, what's the hedging instrument, it has to be a derivative. And then document how effective it's going to be, how I'm going to test for effectiveness, both prospectively and retrospectively, and then continuously test for that. And document this entire relationship and my testing methodology up front. So what happens? What changes? Well, let's do the cash flow hedge first. Well, in the cash flow hedge, the hedging instrument, well, that's going to change. But the hedged risk, that doesn't. The hedged risk is still going to be at amortized cost. Okay. What happens to the hedging instrument is it's still going to be at fair value. And the changes in fair value need to go somewhere. Where they're going to go is to OCI. This makes an assumption that the relationship is effective. Okay. So now it's not going through my income statement, but it is still being represented in other comprehensive income. Well, how about the fair value hedge? Well, with the fair value hedge, one of these things doesn't change, and that is how we handle the instrument. This is still going to be fair value with changes in fair value going through the income statement. So what's the benefit? Well, if you qualify for a fair value hedge, you're no longer doing this at amortized cost or low of cost of market or low of cost of net realized value. You now get to take the hedged risk, and now that's also at fair value. Changes in fair value also go to the income statement. So when this is going up in value, the hedged instrument is going up in value, the hedged risk should be going down in value and offsetting each other in the income statement. If it's perfectly hedged, this net amount will be zero. So how about our net investment hedge? Well, the hedge risk is not going to change. That is under this is all qualified under ASC 830. So this is still going to be fair value with changes in fair value going to OCI. Well, if I qualify as a net investment hedge, we're going to change this from going to the income statement to also going to OCI. Okay? So you can see that this hedge accounting has a benefit of reducing what's actually hitting the income statement and putting a lot of our, in cash flow hedges and net investment hedges, a lot of that action is now going to show up in other comprehensive income. Whereas with a fair value hedge, we're now just marking both sides of the transaction of fair value, and if this is effective, it should offset the gains and losses should offset each other, mitigating the overall impact on the income statement.